All right. Welcome to the next edition of the Multifamily Investor Nation podcast. I'm your host, Dan Hanford, and with us today is a special guest here. We have Randy. I almost Randy messed up your first name here. We got Randy Langenderfer with us. So Randy, great to have you on with us. Looking forward to sharing some of your insights on this acquisition.
My privilege, Dan. It's a privilege to be here on your show. Like I said, I've been following you for afar, and you're adding a lot of value to your audience. So it's just a joy to be here today and tell a story.
Awesome. Well, before we dive into this asset called Longfellow Apartments, it's 139 units built in 1965. It's got some unique features that we're going to be going through and kind of diving into, which is the flat roofs, the chiller boiler system. You know, this is, like we said, earlier in the green room, this is one of those assets that a lot of people pass up and they don't go through. And so we're going to talk about this and how you were able to achieve almost a 2x multiple in about a 21-month period of time.
Yeah.
It's located in Beaumont, Texas. But so before we dive into that, tell the listeners a little bit about yourself and your background and kind of where you are right now on the multifamily side of things.
Well, thanks again, and happy to do so. Yeah, Randy Langenderfer. I'm based in Houston, Texas, as we speak. I've been doing multifamily since 2014. Prior to that, I was a single family hard money lender. I was in that space for several years, and I moved to Houston for business purposes. I'm currently still a W-2 employee at a large academic medical center in Houston. And I got started from single family to multifamily in 2014, attending a lifestyles conference here in Houston, Texas. They're one of the educational groups. I was there for a brief period of time. I got involved in the Brad Sumrock group out of Dallas for about 3.5 years or so, where I really learned the intricacies and the process and what to do from a syndication perspective. Today, I'm a coach in the Rod Khalifa organization, and I've been in his organization for the last 1.5 or 2 years. I'm a GP, KP in about 250 doors, and I'm an LP in several thousand doors. I will always invest as an LP. I just find this asset class to be very good as I continue to look for deals as a GP. And I'm probably like a lot of your audience. I grew up thinking or being taught that to get a good education, to go to work for a large company, climb the ladder, do as best you can. Hopefully you retire well. And though I don't really want to quit my W-2 job right now, and I enjoy doing both, I wish I'd have found multifamily a lot earlier in my career because it's just it's a great asset, as you know.
Well, Randy, I want you to dive quickly, not quickly. I want you to dive very deep into this asset here that you acquired. And what's going to be unique about this conversation, where we don't usually get to dive into it as much, is we always talk about the acquisition side, and we don't really touch on the kind of business, the execution of the business plan throughout the deal. And so this is going to be kind of a little bit more of a deeper conversation, because we're going to be able to talk more about some of the things that happen after you close on the asset, which I know you have some unique things on here. But let's first dive into the beginning stages of this asset, how you found it, how you acquired it, and kind of get into some of those details.
So we found it through a broker. My partners and I are in Houston, Texas. It was a broker out of San Antonio, quite honestly. To give you the headline, is we quickly learned that he was incompetent. The individual wouldn't return phone calls. And so this was we bought the asset in January 15th, 2018. And so this was prior to that. And the gentleman was just in the process of changing firms. He wanted to make sure he maintained his commission, unbeknownst to us, and was doing some just stonewalling us and wasn't giving us information, that we had been asking for. We ended up going around the broker directly to the seller, who was an out-of-town investment group actually located in Cleveland, Ohio. Long story, we ended up paying the broker's commission and stuff, but he just was not cooperating. And when we went directly to the seller, things really kicked into high gear. And that's how we identified the asset and got it.
Do you think that you had to go around the broker to go direct to the seller like this because the broker just didn't believe in the asset? Or do you think they were just totally incompetent and this is how they treated everybody?
That's a great question. I don't know the answer to that one. I would say that I lend I lean towards the fact that he was just incompetent and worried about, he was changing brokerage firms and trying to do his self best. And like I said, after many months of collaboration or not answering phone calls, emails, et cetera, that's when we decided to go directly to the seller. And that's a risky proposition though, especially for a new one, because you risk alienating the broker. If it's a big brokerage house, you really want to use that. That's kind of like the nuclear option almost. And you just want to really use that as a last resort, but we did it and it was successful.
So going through a broker, being fully marketed, were there a lot of other kind of people and that were putting out offers on this property, or was it really just kind of you?
Well, I believe that it was brokered. I know that. I know there were other buyers involved, interested. I assume that the other buyers dropped out of the race once the broker's incompetence became evident and non-returning of phone calls. I don't think he singled us out. I think he did that probably with everybody. And so over a period of months, it's not till, like I said, when we went to the seller directly that things really started to happen, because they were very cooperative.
So at what point during the entire process did the broker just basically start not communicating with you? Was it when you were trying to get information about the asset, or was it after you tried to submit your first offer? Kind of walk us through that.
No, it was really in the early stages of trying to get information. T12, Capex expenditures, rent rolls, gave us very limited information, and as time went on, we would ask for updates. So this probably went on for, I'm going to guess, a good 4 to 5 months before we circumvented them and went to the seller. But yeah, it was just trying to get typical deal flow information. And given the age of the asset, we were asking for a lot of that information, especially, what kind of capitals have gone into it. We knew it had chiller boilers. So what's the status of the chiller boilers? What's their maintenance records? How old are the roofs? Have you had any foundation issues, et cetera, et cetera.
And at what point during this process did you submit your first offer?
It wasn't until after we really contacted the seller. So I'm going to say it's probably 7-8 months into the process when we first got a look at it, a peek at the property. It had a significant time lapse because of that lack of information. So, and once the offer was submitted, it flowed very quickly.
And did the seller accept your first offer?
I know we negotiated some. The property has mansard roofs, so it's flat roofs. And for those who may not know, mansard is more of a 70s, 60s, 70s build style of asset that has kind of a horizontal roof to the side of it that instead of siding. And so we were negotiating around that because there had to be some repairs that were evident to those. And so we ended up getting a credit for those of that in the actual final PSA.
Okay. And then what was the final purchase price that was agreed upon?
It was 139 doors. It was, we had a 5.5 acquisition and a $900K rehab budget built in for a total of $6.4 million was the total acquisition price.
Okay. And
$45K a door.
$45,000 door. And did you have any hard money that had to be put up, or earnest money deposit or anything like that?
We did. We had a $50K earnest deposit down. It did go hard. We went, we asked for a early access agreement, and the seller granted it to us. So we did have a 14-day early access agreement, but our money went hard after that.
Okay. So it was a hard day one, correct? Because I'm assuming that the early access was for 2 weeks, but then the PSA was signed at that point. That's what made it hard.
That's correct.
Okay, good. And anything after the due diligence period, was there additional earnest money that had to be put up or anything, or was it just a straight 50 for the whole period?
To my recall, it was 50 for the whole period.
Okay. And was it a typical 30, 30, 30 as far as the actual terms?
Yes, as I recall, you're challenging my memory now, but it was pretty standard. Yes, at that point in time.
Okay.
This was an owner group that had literally owned the asset for 25, 30 years, and had just they lived in Cleveland, Ohio. The asset's in Beaumont, Texas, as we discussed, Beaumont, I said, is about 110 miles just due east of Houston for your listening audience. And the ownership was in Cleveland, Ohio. One of the owners had died, and so their late 70s, early 80s group, and they were just wanting to cash out. And they had basically just been milking the property for several years, not putting a lot of money into it. So thus the $900K capital improvements that we had budgeted into the property.
So at what point during this entire process, obviously it took you, 7-8 months to get it to the point of having a signed PSA, but at what point during this entire process did you do like an initial tour of the asset as well as kind of a tour of the market around this asset?
Oh, very early. We secret shopped it when we heard about it. We went out and individually, partners and I went out and secret shopped it as if we were renting a unit, started driving comps in the neighborhood that we knew about. And Beaumont's a city of about 250,000 people, a lot of rentals there. So this aging asset was in a very good part of town. And the good thing about a 1965 build is it was built like a tank, concrete floors, concrete structure. The only thing wood in it was the interior walls pretty much. But very early to answer your question, we wanted to get an idea of the market.
What were the average effective rents when you acquired?
We were averaging 91 cents a square foot, or about $870 per unit rent, which even in Beaumont was low, very low. Our pro forma was to bring that up to 95 cents a square foot, or about a modest $905, or basically a $35 a month or 4% increase in pro forma, and we ended up blowing that out of the water because we had a tenant base in the property that had literally been there for many of them 10, 20 years. Many of the tenants had upgraded their units at their own expense. Never seen that before. They had put new kitchen cabinets and stuff in the units and bathroom fixtures at their own expense.
That's very interesting.
Never heard that one, have you?
I think I've heard it on one other interview we've had. I've had that happen before, and it was very interesting. But I don't think they were actually good renovations.
These were good. These were good because I was amazed at the quality of the cabinetries they put in there. I mean, as a syndicator and as a multifamily guy, we're going to go to the big box places and buy cupboards, but they had nice oak cabinets with sides and fronts, not just the fronts. So anyhow.
Well, that's nice. Well, walk us through the $900K in CapEx. What was the plan for the CapEx side?
Yeah, so we knew that it was chiller boiler, as we said. So we had in our CapEx proposal, we had decided we were going to replace the two boilers. The chillers were fairly new. One had been replaced within the last 18 months, and the other one was only about 4 years old. So if you do know anything about chiller boilers, those things should last 25 years easily if they're maintained and maintenance regularly. So replace two boilers. There were 12 different buildings. We were going to replace two of the roofs. We had, for about half of the units, we had 7,000 a door interior upgrades planned to come in and make interior upgrades. We were going to upgrade the clubhouse or the leasing office for about $55K. The whole unit it was brick, but had a lot of paint. So we wanted to paint the whole exterior, and then simple stuff like signage, put a monument sign out front because it had nothing. It was right next to a highway. They were missing a golden opportunity there. And then some minor landscaping just to spruce up the aesthetics. So totally $900K.
So I don't know too much about chillers and boilers. I know what they are and how they work and things like that. But what does it cost to replace one of those?
Well, Dan, I never did either, but I happen to know now. Just a boiler. And so just for the listening audience, I mean, a boiler and a chiller is what you see even today in your commercial buildings. It's a very efficient manner of heating and cooling than even the standalone units we have today, but they're very capital intensive. And the challenge is when something goes bad, it goes bad for all 139 units. It doesn't just happen at one or two units. So you'll see a lot of properties today with boilers just to provide hot water heat to the units. But this boiler system provided the hot water heat, and it also has a pipe that flows underground to the buildings and up through the units. And then there's a condenser there where an electric motor blows air over the condenser and provides heat to the unit when the water is hot. And then conversely, when the chiller's on, it reverses and it pumps cold water through there and chills the unit that way, or cools the unit that way. And as you know, the Texas summers get really hot, and so that becomes very important. But the answer to your question is, boilers are probably $30,000 to $40,000 a piece, depending on the makeup. A chiller, on the other hand, is much more expensive. That's anywhere from probably $120,000 to $185,000, $90,000 per unit. And we had 2 on the property, dividing the property up into 2.
Wow. I knew that they were expensive. I didn't know that they were that expensive, especially the chiller side.
Yeah. And as I tell people, one of my mentors told me when I was looking at the property, Randy, don't do it. Don't do it. They're just too capital intensive. And, when they go down, they go down. But like many new people, new sponsors, we were excited and thought we had a business plan to address it. And we did so.
So as you were walking through the Capex plan, there was a word that I noticed you using, and I think there might be a story behind this, but it was, we were planning to spend this and we were planning to spend that. So walk us through what actually happened.
So, yeah, thanks. So it was a we ended up still doing much of it, but so we purchased the building. I think we closed on January 15th of 2018. We're all excited, high-fiving each other, et cetera, ready to get started. We take over the property. We had some property management issues that we identified due diligence wise that we were prepared to address with the on-site person and the manager. But before we even get into that, that if you do this long enough, everybody said, Randy, you're either going to have a lawsuit or you're going to have a fire. Well, approximately, we buy it mid-January, and at the end of February, I'm in my office, my W-2 job, and I get a call, Randy, the building's on fire. I said, you're joking. This is a joke, isn't it? And it wasn't. Tragically, it wasn't. And turn on the news that night, and there's the news stories of flames coming out of the building. And so I realized I may have a fire one day, but I didn't think it would be month 2 of ownership.
Well, we've definitely had that phone call as well, but never. I don't think it ever made the news like that, though.
Yeah, you're in a little bit bigger market, Stan. So, the 24 units ended up getting affected out of the 139. We were really, really fortunate that nobody was injured. And I'll repeat, because we had begun some of our CapEx projects. So we had our contractors on site. They were starting to help. And in that process, they were able to go door to door and get people out. Remember, we had some really old tenants that had been there 20 years. And so they weren't, we were just really thankful. And for me, that's the biggest takeaway about the fire. As an investor, as an owner, we all tend to think analytical stuff, but at that point you have to put all that aside and really worry about the tenants. How do you get them housing that night? What are they going to do for food the next day? The short answers, I'm sure is we found the property management company. We called in American Red Cross, and they provide emergency services, which is fantastic, and every potential syndicator should know that and use that. And then it's just the logistics. Once you get the fire out, everybody's safe. You get the tenants temporary housing. So, what are you going to do? How do you board up the property? All the tenants want to come back and get their stuff out. When do you start the rebuild? So it was a fascinating learning curve. One I hope I don't have to repeat, but we did learn an awful lot through that process.
And so what else happened? I know you also have had some other kind of issues that came up. So what are some other things? You had the fire in February after you acquired it, about a month prior. And what else?
So as I said, when we were doing due diligence, we realized the property manager the on-site property manager had literally been on site for 25, 28 years. She had raised her family there, and they were gone. She was very. These people were her friends. They were her colleagues. They weren't just tenants. They were her friends, and their families socialized together and stuff. She lived on site. We recognized that when we did it, but we were willing to give her a chance. But once we bought it, I said our pro forma was only 4% rent increases, but we started immediately bumping rent $75 a month. So we took it over in January and February. We started bumping rent $75 a month, and we were getting it. They were staying without making any changes at all. And we wanted to be even more aggressive. And as time went on and as the fire happened, the on-site manager became overwhelmed with it all. And so we, as an ownership group, made the decision in the springtime, March, April-ish of that year to replace the on-site. We were going to keep the property management company, but replace the on-site. Beaumont, Texas, there's not a big learning curve for I'll say on-site property managers. We ended up finding a wonderful lady who came with a commercial real estate background, but she didn't have any multifamily background. And so we inserted her and started working through the process of onboarding her. And it became very apparent that the back house property management company really didn't have any support for her. I became the de facto regional manager to this woman, with limited experience myself other than the classroom. And so I was spending a tremendous amount of time. We were having daily, weekly calls at a minimum, talking about rent renewals, I should say, rental renewals, maintenance requests, advertising, you name it. We were talking about it. I was spending at least 12 plus hours a week on this asset, helping this lady get engaged. They were converting from a manual operation to an automated operation. And you can imagine the learning curve, as well as rebuilding with the fire. We decided pre-buying that we were going to be the general contractors. And so we were concurrently trying to do the Capex upgrades on the other units, as well as the fire rehab. And all the paperwork with the city and all that stuff in the 1965 build, when you start to do remediation, realized there's asbestos in the building, 1935, just in the drywall, and that very common. So, expenses escalate significantly. So we're concurrently trying to work rent upgrades, capital, CapEx, fire rebuild, change the on-site, working with her a lot. And then we're working it, and it's going. We're continuing to make increases, unit price increases. Tenants are continuing to pay the upgrades without any renovations. So we're trying to get really aggressive in terms of $150, $125 a month, just so we can get tenants out, so we can make unit turns. Which, because we had, the lender requires you to get all that done in the first year. In the spring of the year, in the summer of 18, I'll say early fall, September, October, we as an ownership group decided we need to make a property management company change. So we decided we were going to keep the on-site, but we were going to change out the back house, because this company that we had retained, we learned had really expertise in HOAs versus multifamily. In an attempt to appease us, the owner of the property management company retained a consultant to help with the on-site work, and became apparent that the on-site consultant and the construction firm that we hired were butting heads and became counterproductive. So this all led up to a change, I'll say, in the fall of 18 to another property management company that had back house operations, resources, as well as tools, processes, and techniques to support the on-site. And we made that change. We made our first distribution to investors in the fall of 18. We changed out the property management company there in early 19. the saga continues, Dan. Chiller boiler property, boilers start to have problems in the winter. And in Houston or Texas, if the heat gets below 50, the natives are pretty cold. And it actually did get down to in the 30s a couple of nights where we didn't have heat in the property. The boilers weren't working. Again, back to the chiller boiler situation, that there's not a lot of people to work on chiller boilers, especially in Beaumont, Texas. So we're bringing in people from Houston, trying to get this ancient technology to work. We had replaced one of the boilers. Long story. Piping, technical parameters that need to be replaced. But there's another operational issue there of, again, going back to the tenant focus. So bringing in coffee to the club, to the leasing office in the clubhouse, making meals available to tenants, hot meals available to the tenants, really trying to appease them and keep the communication lines really open as to what we're doing to fix this. And just praying that they don't call the city or the county and, some agent shows up. So it's just trying to really put the best face forward and tell them, long story, we got it fixed. We got heat restored. And we're going on, and on spring of 2019, we're hitting on all cylinders. We got the lease upgrades made, the fires redone. We got those units back online. They're gorgeous, getting a big premium. We got the reimbursement for the lost lease from the insurance company. We're truly hitting on all cylinders. We get a broker's opinion of value, and they give us some very good news that the market helped us out in that time period. And so, fast forward to November of 2019, we sold it, and we were able to return a 1.95 equity multiplier to the investors. So, long story, but a happy ending.
I do have a couple of questions for you. One was about the property manager on site. Now, some that might be listening might be thinking that, having a property manager that on site that knows the property very well, they know the residents very well, they have a great relationship with them, that it's actually a good thing to keep that on site. So I know there's different schools of thought here, but walk us through what your mindset was, because obviously in the beginning you decided to keep the on site as on a trial basis, if you will. But walk us through some of the reasons why that might not be a good idea.
Yeah, and I think your explanation or your intro, your mindset is spot on. I mean, we valued her local access to contractors and markets, et cetera. She knew every property in the city of Beaumont and what they were doing and who owned it and what the rents were. So there's valuable information there. But we wanted to give her the try, and we even told her about our business plan to raise rents. That was our business plan, was to grow NOI and raise rents. And it really just came down to it. It was her personality that she couldn't do that. She didn't want to tell the tenants she was going to raise the rents, because she did it for a couple months. But when we started getting aggressive and bumping it even higher, she just couldn't do it. And so, we converted her to a tenant from a on-site property manager. And
so she was living on site.
She was living on site.
Yeah. And that's definitely where the rub really hits is, when you try to raise rents on somebody that you live next to for the last 20, 25 years, and they don't want to raise the rents, then she's got to evict them. That's really kind of where it is. She's too close to the resident base to be able to, affect any change.
Yeah, and I think the other thing is we really tried to navigate a soft landing. We didn't have to do anything, but we didn't want her talking to the tenant population afterwards, bad-mouthing us as the ownership group. And I think we had a very positive story to tell in the new on-site, which was extremely young, energetic, ambitious, very, very good communicators. And we were making a lot of amenity with the fire rebuild, the roofs, all the exterior stuff. They could see progress. And so I think it helped too that ownership was making all these visible changes to the tenant base in that time period.
So about the chiller and boiler system, here's a question I have for you about this. Will you ever buy another asset with a chiller or a boiler system?
No.
Well, that's the answer I was looking for.
So, and as a coach, when people talk to me about this, I say, I'm not going to tell you no. I would say for me personally, no.
Yeah.
But that's my strategy. Someone else, I don't, tell other people what to do, but that's I would say for other people, it should be a giant red flag. That you need to really understand the maintenance. And, I learned a lot about two-line boiler systems or two-line chiller system versus one line, et cetera, et cetera. And when it was put in, and how do you find a replacement? And, imagine in the heat of the South, that was what we were afraid of. If the chiller goes out, you've got 139 units down. You're not down 1 or 2 or 3 units. You're down 139. So you got to bring in a temporary chiller, cut the lines, re-plumb them into the temporary chiller, and that's at a minimum of $100K. And so,
wow,
yeah.
And that's just for the temporary.
That's just for the temporary, because you're going to have this mammoth piece of equipment shipped in on site and then replumbed the existing in from away from the permanent one. Thank goodness it never happened. But when I coach people, those are the things I would say to be prepared for. You need to have a really big capital reserve as a lever to pull if needed.
Yeah, man. So let's kind of shift and pivot here and talk a little bit about the debt that you put on this asset. So how did you end up financing this deal?
We put traditional debt on it, agency debt. It was a 30-year AM with a 10-year renewal. Actually, we elected 12 years. I'm a big proponent of permanent financing, and we put 12-year on it. And I think it was a Fannie small balance because we negotiated and bought for a step down prepayment versus yield maintenance. Because at the time, cap rates were declining. And so that's going to make your yield maintenance even worse. We wanted to have an exit strategy. So we did that.
So when you ended up selling the asset, did you do it with an assumption or did you pay the prepayment penalty?
It was a cash out. So we actually paid the prepayment penalty. It was a step down, so it would have been, I don't know, I think 5, 4, 3, 2, 1. So I think it was probably a 4 in year 2, 4% of the interest, but ended up being okay. Okay.
And what was the interest rate that you got on it?
I knew you were going to ask me that one. I think it was like 4.5 at the time, in that range fixed. But I just go back to, I think that was a good decision for us at the time. I know everybody's strategy is different today with bridge and variable rates and stuff. But if I ever can, I'm still always looking for permanent debt.
And did you have any interest only on this one? Was it
1 year?
1 year. So 1 year IO, and of course, non-recourse if it's a Freddie SBL.
Yeah.
Yeah. Okay. What was the LTV?
It was 80%. We were able to get the loan to value.
Okay.
In Beaumont.
80% LTV. And this is a question I don't always ask, but I'm curious. Were you able to do your own guarantor as your own guarantor? Did you have to bring in an outside person? And if you had to bring somebody outside, how did you find that person?
We were able to do it ourselves. The sponsorship group had the net worth and the ability to be the guarantors on the loan.
That's always an advantage to have that. So that's good.
Yes, it is. Yes, it is.
So how did you end up structuring the deal with investors?
So yeah, that's a good one. We have obviously, there's a lot of different models out there. So we were of the opinion it was a straight 80-20 equity split. With the 80% to the limited partners and 20% to the general partners. I think we had a 1.5% asset management fee, a 3.25 property management fee, no acquisition fee, no liquidation fee. Pretty straightforward.
So just there's no preferred returns, no different hurdles on the waterfall, just a straight 80/20. That's it.
Correct.
Good.
The simple model, as we would call it today.
How much did you end up raising on this one?
We had to raise 1.5 million.
And how did you do it, and how long did it take?
Well, that turned out to be one of the successful part of this. We actually raised $1.5 million in 2 days. And so it was just preemptively, there were three other partners and I, working our individual networks. We had a webinar. We invited everybody we could think of to the webinar to explain the deal. I had closed several, a couple of high net worth individuals that were coming in for the first time and building a relationship with them. But old fashioned way, just networking, webinar, chasing them down as to when they're going to get their money in, and happy we did that, and we were able to get the commitments in 2 days, and then just worked it.
So let me just walk through this just real quick, just to make sure I got the timeline correctly on here. So the deal was closed in January of 2018. About a month later, we have a fire on the asset. A few months later, property management on site, we decided we needed to change this. Second thing that happened would be, or the next thing that would happen there was we had to change the actual property management company, because it was not really a proper property management company for this particular asset. And then first distribution happens in the fall. We start doing some lease up in 2019, get a BOV, sell the asset in the fall of 2019, and have a nice 1.95x multiple on the initial equity upon exit in a 21-month period of time. Have I got that correct?
Yes, you only missed one data fact there, which was approximately a year into it, which was the winter, like January of 19, when
chiller
the
boiler system.
Boilers started to have problems. And that's when we kind of made a decision. We need to get out of this thing before something else happens.
That's great. That's great. I knew I was going to miss something, so I'm glad you got that. So I know we've covered a lot already today on this episode, but is there anything else that you can think of that we haven't covered yet that might be beneficial for our listeners to know about?
I think the only thing I would say is, and I know you're a mentor to a lot of people, but having a lot of mentors and people that help you along the way. So there were a lot of fellow syndicators, people that helped us along the way. One, to get the deals structured, to get it done. And then two, when challenges started hitting, like, do you know any chiller boiler maintenance guys? And working that network from Dallas to San Antonio to Beaumont, and the value of that network of syndicators and mentorship groups is the other piece I would say for your listening audience.
So I got two final questions for you to wrap up the episode, and they're kind of contrasting questions, but the second to the last question is, what did you find that was easier during this entire process that originally you thought was going to be a little bit more challenging?
I would say the raise. I think the raise was a very pleasant surprise to get it done. Obviously, everybody, until that's done, you're never sure. But yeah, even though, by today's standards, $1.5 million isn't a lot, but pleasantly surprised that got done as fast as it did.
And then the last question is kind of opposite of that, is what did you find that was maybe a lot more challenging that originally you thought was going to be more like a walk on the park?
2 words: chiller boiler.
I knew that was going up.
You led me right into that one, Dan.
No, that was great. That was a great way to end it. Great way to have a good lesson and takeaway from this episode. Still had great return, but I think it's because you got out before you had to spend too much money on that chiller boiler system. So, I'm going to thank you, Randy, for taking some time to be here and participating in this podcast. How can the listeners reach out to you if they have some further questions for you about this asset, or maybe they want to follow you more?
Dan, thanks again. Really appreciate the opportunity to speak to your audience. And the easiest way to get a hold of me is my website is invest-arc, A-R-K. It's invest-arc.com. And there's a contact page on there. I'd love to schedule a call with anybody that wants to hear more about the story, or just help anybody along their journey of real estate, as many people have built into you and I along the way as well.
Awesome. Well, again, thank you so much, Randy, for joining us here for this episode. Looking forward to continuing to follow you as you close more deals, and looking forward to having you on a future episode.
My pleasure, Dan. Thanks.
Thank you so much, Randy.